Hi, everybody. I'm so excited today that I am sharing a lot of data with you about our housing market, about what happens after election. And also, we just heard that vaccine is coming out soon. So what will happen to our housing market? But before we begin, I want to remind everybody to hit subscribe to our channel and also click like. I did spend a lot of time doing some research, so I feel like it will be an encouragement for me to continue to do this. And also, well, I want to make sure that this is very objective. The data that I'm showing you is from all of my research, so hopefully this is helpful to you. So I would love to share some of the local news first, and then we're going to go into some of our, the United States housing market, what we're doing, and what is the forecast by different organizations. Actually, this is in the Bay Area with 5 counties, all the aggregate numbers. We have been stacking up this chart since May. And if you looked at May number, it used to be all red. But now we have seen that it's been positive number all the way through to October. And as you see that we have increased new listings 40% compared to last year. And then we continue to have more properties went under contract, and also more properties had closed as well compared to last year, 2019. And if we look at this chart, we are comparing the single family homes and the condominium in the Santa Clara County. So if you look at the yellow circle here, we're comparing the number of days being sold. If you see single family, this is all under 10 days. It stays on the market for 10 days only. But condominiums and townhomes, they do tend to stay a little bit longer nowadays because I think I've been mentioning quite a bit for the past few episodes is that people have shifted the way they live and the way they want to buy their homes. So they are really looking for a single family more these days. And then also, if you look at last year, we all have experienced a slowdown of the market last year. But as soon as January started, we actually saw a huge increase on like the competitiveness of all these listings. This is same for both single family and also condominiums. Last year, for the condo, you see that it's hovering around 99% to 100%. But in the beginning of the year, pre-COVID, not after COVID, but pre-COVID, it had jumped up to 102.6% for condo, and single family was 105.5%. But of course, the COVID happened and shelter in place happened. As you see in May, everything dropped to zero because we stopped counting days on the market. At the time, we weren't really open for people to go look at homes. But after May, we opened. And although we're not as aggressive as pre-COVID back in February and March, in single family, you still see that they all started going back up again, and it's average about 103.2% in terms of the offer price over the asking price. And then the condo is not as aggressive. It's right around 100.8. It's not that much below asking price, but it's not too much over asking price either. And here I thought it would be fun to share with you guys is that you see all these, the number of new listings historically since 2003. So this is 17 years of data. And we are still historically low compared to other years. 2012 is probably one of the lower ones. But as you see, like 2006, 2007, 2008, we have quite a bit of inventory on the market. But right now we are definitely a lot less than before. Now here, let's compare Santa Clara County. We have our number from last month compared. This is September 2020 compared to October 2020 number. And September, we were talking about like the closed sales has gone up, and it's still, compared to last month, we have gone up more again for single family, as well as for condo and also townhomes. The number of closed sales has gone up. Not to mention, it has gone up quite a bit also for compared to 2019, 32.9% for the month of October, and also condo was about 13.4% compared to last year, October. And also the median price continued to go up. And for St. Clair County now, our median price is at 1.445. It's 17% more than last year, while the condo and townhouse is about 2.7% more than last year. Well, San Mateo County is a little different though. In San Mateo County, you'll see that since last month we've been seeing a dip on the price. And single family residents here, the median price last month was 1.77. And then again this month, we dropped a little bit again to 1.68, which is about 4.9%. And they are staying on the market still fast though, about 22 days on the market. But they do have more listing that came out, which was about 16% more compared, sorry, it's like closed sales, 16% more closed sales compared to last month. And same thing for condominiums, the price has come down. So I thought it's quite interesting, especially if I share with you next slides, where this is all the East Bay counties, and you will see that there's quite a bit of difference. Now, a big picture for the East Bay is that the home for sale down more than 30%, but then the median sales price up 13%, and the average days on the market is 18 days. The pending sales had gone up 49%. Now, if you look at the 880 corridor, you see everything is green, and they had gone up so much. Albany had gone up 20%. Union City has gone up 24%. And here is West Contra Costa County. If you look at El Cerrito, 33%, San Pablo, 26%, and Central Contra Costa, it has gone up quite a bit as well. A lot of them has gone up like double digits, besides of Martinez and Clayton. They only went up about 1% of 4%. While if you look at La Marinda, it has gone up 14 to 30%. Tri-Valley, it went up from 8% to always 47% for Alamo. And also here we see that Antioch, Brentwood, Discovery, Oakley, and Pittsburgh, they all went up double digits as well. So as I mentioned, that East Bay has gone up quite a bit, and you know, we can really see that people are moving away from a little bit more expensive area. We, even us on the ground, we see our clients, talk to our clients, a lot of them say, you know, we are working in San Francisco, we're working in Peninsula, but I think East Bay is more affordable because we don't have to go to work as much now. We are able to work from home, so they would much rather pay less money for bigger homes than being in Peninsula. And after looking at that statistics, you could definitely see that migration. Now, regarding the mortgage loan, a lot of people have been talking about, are we going to have housing crisis in 2021? So let's take a look at some of these mortgage loan statistics. There's less actual delinquency rate. We have dropped 3.1% in September, and also went down 43,000 on serious delinquency. Serious delinquency, this is talking about more than 90 days past due. And the prepayment rate actually is talking about like they're actually coming back and paying back is about increased by 12.7. And these data as it come from Black Knight, and I really enjoy actually looking at Black Knight report because they provide so much statistics. And then you also can see that over here, this chart is showing, specifically, I would like to look at this green line is talking about how many new loans that has gone into delinquency, for example, to 30 days. And if you look at this number here, which is in September, it actually went back down to 2019 level, pre-COVID level for sure. And also here, even the pre-COVID here, which was around February and March, is actually lower than that. So I thought that was quite interesting, where we have less new delinquency coming out on the market. Okay, and what about forbearance? A lot of people talk about forbearance. And here are two charts that I want to show you regarding forbearance, which is this chart actually showing you guys all different loan programs. For example, if we look at this, what it says here, strongest were among loans held in portfolios and private securities, which are down 21% from the month prior. And same thing here is talking about how many loans, if you see these darker portion, is talking about how many loans are back to payment So they're out of the forbearance plans. So for portfolio and private securities, those have 41% that came back to be re-performing. And here, and if you look at the forbearance plans among the GSE loans, they were down 18%, and 42% here have become re-performing. But if you look at FHA and VA loans, they see probably the most modest decline of 14%, so less than the portfolio and private securities, and also less than the GSE loans. And also here it says 21% of VA borrowers are reperforming. So they are less than the portfolio and also GSE loans, and they're about 21%. And as you know, a lot of VA loans, they are actually 0% down. And 27% for the FHA, they are reperforming, and only 6% have paid off their loans. And FHA, also they have the 3.5% down payment program. So as you see that, it's very interesting. You see that most of these lower down payment loans have the higher forbearance plans still. And again, I think if you look back to where we are in the Bay Area, we don't have as much of these FHA and VA loan programs. So that's why we're not getting hit as hard. And here again, you look at state by state rankings regarding non-current loan population. California, we are actually one of the lower one. We are all the way down below. The delinquency is 5% compared to the national 6.7, and the foreclosure percentage is 0.1% national, California, and national is 0.3, so we're below the national level, as well as this non-current percentage, which is nationally 7%, we are at 5.1%. Although we did definitely have increased quite a bit compared to before. However, if you comparing nationally, we are much less than what the national level is. And it also, again, go back to, I think if you hear a lot of news outside talking about the housing market, I just want to remind everybody to make sure that you're looking at locally. Even we're talking about California, obviously California is huge and there are a lot of different markets. Bay Area market and Southern California markets are still very different. So here is just kind of like a high level to show you what California market is doing right now. And Freddie Mac have their forecast, and the forecast here is talking about that 3-year, the home sales for 2020 and 2021. As you see that they actually have a higher sales volume that they're predicting, meaning more people coming out to buy. And then they're predicting the mortgage rate is a little bit lower than before. You see 2018 it went up to 4.6, and 2019 was 4, 2020 is going to be 3.2, and 2021 is 3%. And so the house price growth, the growth was 5.1% in 2018, 4.2 in 2019, and they have adjusted to 5.5 for 2020, but 2021 is actually a little bit more moderate. And I think a lot of people wonder if 2021 is going to be a transition period where the prices might come down slightly. To me, I think it is still going to go up a little bit. And I will talk a little bit more why I think it will still go up, but at the same time, it's not going to be as aggressive. Just like what Freddie Mac here is forecasting. But if you look at other organizations, this is what they're forecasting. For Zillow, Zillow is forecasting 7% appreciation, Zelman 5.9%. As you remember from last month, we talked about they literally double their projection from 3%, I think, to 5.9, Freddie Mac's 5.5, NAR, National Association of Realtors, 4.7, HBC 3.7, MBA 3.1, which is the Mortgage Banker Association, and CoreLogic is the most conservative at 0.2%. While Mortgage Banking Association, they are forecasting that these are the rates it's going to be for 2021. It's going to go up a little bit, 3.3, 2022 is 3.6, and 2023 is 3.9%. What about multifamily market now? We also very worried about the renters are not paying, especially we have eviction moratorium going on right now. But then if you look at, this is from the rent payment tracker with National Multifamily Housing Council. their tracker actually shows that 80.4% of the renters are still paying rent. And if you put that here side by side compared to 2019, we're pretty close to what 2019 was doing. And we definitely saw a dip here in July, 77.4%. But I think overall, 80.4% is very much in line with what we were doing in 2019. What about the employment and supply trends forecast rent growth? The Inland Empire and Sacramento lead our top 30 market rankings for year-over-year rent growth as the neighboring Los Angeles and San Francisco continue to bear the brunt of renters moving out. The average rent in the Inland Empire is 23% less than the average rent in LA, and the average rent in Sacramento is 34% less than the average rent in San Francisco. So that's why we also see that quite a few people are, because of the current situation, pandemic, and then working from home, we do see more people moving to less expensive area out of San Francisco. And in October, the employment rate actually fell below 7% nationwide. But we do see that workers with a bachelor degree or higher have suffered less job loss. And here, Yardi is like a software that most of the property management companies use. So they collect a lot of data. And here it says that there will likely be another round of government stimulus. But given the divided Congress, the total package will be less than if the Senate had flipped Democratic. For property owners and operators, additional stimulus and employment benefits paid to residents will help cover housing costs, especially in the workforce housing sector where job loss is most concentrated. So, one thing again that we worry the most is that if there are a lot of job loss, people cannot pay for their rent, and what happens, that just keep rolling to basically the landlord cannot pay for their mortgage, and then the property is going to get foreclosed, and that can cause a lot of housing crisis. And now that we know that Biden is our president-elect, he does have an emergency action plan to save the economy. You can go to his website and read through it. And he does have a new stimulus package that he has been talking about. And because the Senate right now seems a majority still Republican, there is a chance that we do believe that these stimulus packages should be able to be passed. So hopefully that will help help with the stimulus package being able to help some of these tenants and also property owners. So we talk about eviction moratorium. The eviction moratorium had been really scary for a lot of people because it also caused sellers to say some of the sellers just cannot afford to pay for the mortgage payment, so they really need to sell. But then the multifamily family buyers, like our buyers, same thing. They don't want to buy it because they don't know what's going to happen. And then most of the landlords do want to work with the tenants, but at the same time, they are kind of caught in the middle. They cannot afford to lose their building either. So that's what additional stimulus package for the housing and food expenses is really key to ensure the tenant can pay rent and continue to keep the landlord and tenant relationship healthy. So real quick, lastly, is that Bay Area housing market. Just want to go over these propositions that we just saw. Prop 15 that changed commercial property tax. It didn't go through because if this were passed, it definitely would increase the consumer costs. Proposition 19, changing the property tax rules specifically for wildfire and disaster victims. This is important because it continues to help elderlies and also these fire victims to move to more suitable areas. And Prop 21, we are limiting market rents, and it didn't pass, but if it did pass, it actually limiting market rents on new tenants, which will then discourage landlords to upkeep the property, and then the property is going to become very dilapidated. So it will discourage investors to come invest in California. So I'm really glad to see that Prop 21 did not get passed. And in Bay Area, we still have this housing shortage, and we are 400, as of October 24, we have 441 housing unit needed. So RENA has been coming up with that, coming up with plans and asking local cities to implement and try their best to encourage housing developments. And in California, they are actually allowing local governments to do their parts instead of doing a California's law to these cities to build more housing. Because of that, as you see here, UC Berkeley have done a research saying that the LA versus Fremont, the development cost, development fees it has such a drastic difference between these different cities: Los Angeles, Sacramento, Roseville, Oakland, Irvine, and Fremont. And depends on which city you're building, you will see a very, very different development cost. And we talk to developers sometimes, and a lot of developers do say that they don't really want to build in certain cities because of the cost. And then because we have been printing money, we have increased quite a bit of these, reserve funds. The money supply has increased drastically from $3 trillion to $7 trillion. And because of that, plus the low interest rate, the dollar will become weaker. So as a matter of fact, because of that, more people are going to look into buying real assets instead. And foreigner, we're going to see probably more foreign investors, because when they compare globally, are in the United States, we're still a little bit more stable investment compared to other investment. And then lastly is that the vaccine, if the vaccine really does come out, more sellers probably going to be more comfortable to sell. And that's why we probably have a little bit increase on the inventory, increase on the new listings. That is the reason why I believe that in 2021, even though we will continue to have high demand, but we also will have probably high inventory. So the increase in prices will not be as significant, but we will still have moderate increase.
Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.